Okay, hey, good morning. Sorry, I'm a little bit late dialing in here. It's been kind of a busy morning here so far. Let's jump in and get right to it. Okay, fundamentally, first and foremost, um, let me think about how to really communicate this. But fundamentally, what we've got going on is short term, long term. Okay. Um, Let me start with China. Um, the Dalian corn is out to new records. It's over 10.50 a bushel. It continues to go higher, and it's in the middle of their harvest, just like it is here. So imagine um, what it would take for us to rally corn to 2.50 or $3 a bushel in the middle of our harvest, and that's what you have going on in China. Um, you also have um, China doing everything they can to combat the rise in prices. So um, they're auctioning wheat, they're taking and cracking down on speculative bans, preventing speculators from rushing in and buying the markets and commodities. Their energy prices are just soaring and out of control. They've got major issues. And one of the analysts yesterday, and I have it written down here somewhere, but I lost my notes. One of the major companies yesterday, I think it was ADM, came out and said China is going to need 100 million tons of soybeans in the next 12 months. That's how much they need to import. So to put that in context of um, between South America and the U.S., they've got to buy basically half of our beans in order to make that number work. Right, 100 million metric tons is 3.5 billion bushels of soybeans. So between South America and us, we better have big crops because China has to have all of them. Now, um, you look at the short term though, and you look at lack of exports, you look at high ocean freight, and you look at the size of our crop, and you kind of read the news, and you just hear over and over, um, we are oversupplied on beans, right? We're going to raise our carryout. It's gonna be huge, and so we need to take beans much lower. But yet the market just won't break, and we've talked about this for weeks and weeks. What's going on? Why won't they break it? If we're going to go from 120 million bushel carryout to 350 or 400 million, we should break this market, and they just haven't not been able to do it. And put it in context of what you're looking at here on in terms of the weeklies, right? We haven't been able to break down inside these clouds, and one of the reasons for that is this pent up demand in China. But then another one that's hold on, let me find it here. Here, I don't know if y'all saw this article or not, but I wanted to pull it up. Another major factor driving, I think, the underpin strength in beans is this concept in this article, and it's all about fuel. Now, from an energy standpoint, right, we have oil screaming, we have natural gas screaming, we have inputs screaming, we have all these things working higher. But structurally, what we have is a massive return to travel. Um, we're driving more than we ever have. We're using and consuming more than we've ever done, and so there's a huge push to move towards sustainable and renewable type fuels in order to extend um, petroleum. So the Biden administration talks about eradicating petroleum and doing away with it. And I think that's just total nonsense. The reality of it is we consume more energy every single year. We're humans. We consume. It's what we do, right? We push and we drive to more and more. And so what's interesting about this article, and this is on AgWeb, you guys can find it, um, is this graph right here, which is talking about the fact that over the next 4 years, we need to add 30 million more acres of soybeans globally in order to meet the projected renewable diesel demand and avgas demand by biodiesel and by straight sustainable aviation fuel. Okay, so the difference between biodiesel and sustainable aviation fuel is that biodiesel you blend like ethanol, and sustainable aviation fuel you don't. And this is bullish ethanol here too. So as we've learned how to refine and make this these fuels really powerful, what we're finding is that the aviation industry really likes it. And this makes a lot of sense because it's a pretty confined infrastructure too, right? You don't have to put it in millions and millions of pumps. You can put it in a few pumps because all the airplanes concentrate into big regional hubs. So it makes a lot of sense that you could do something like renewable fuels and get a unit train of it, right? So this makes a lot of sense. So short term, this looks more bearish beans than it does long term because it takes a little bit of time to ramp up. So they're looking at a 3 million acre switch between corn and beans for the 2022 growing season. They're looking at corn losing 3 million acres and beans gaining it because of the fertilizer prices and the cost of inputs. Whether that happens or not, I don't know. But 90 million acres of soybeans is a big number and would and probably should put some pressure on this market. Okay. But if you look forward, then it would be overwhelmingly bullish because we need to increase crushing capacity by 60% this time of year. Now remember, China needs to buy half our crop. We can't increase it 60% to domestic crush and supply that need. That's too much demand. So if this kind of stuff starts to take root through 2022 and becomes more and more prevalent and likely, get out of the way because this is overwhelmingly bullish. I mean, this is the equivalent of looking at corn demand increasing from 2004 to 2008, right? I mean, this is the RFS, but this isn't mandated. This is being driven by economics. And the interesting piece is that these are the companies that are kind of leading it, right? You got some pretty big ones here, I think, partnering. You've got Big Ag and Big Oil partnering together to meet this demand. So I'm not going to hammer this any further, but this could be a reason why beans have not broken, even given the poor fundamentals that we currently have. Lack of exports, high ocean freight, huge yield, terrible meal demand, or at least terrible meal prices, right? You've got all these underpinning or all these bearish fundamentals that are really honestly being supported by the market. So stay tuned to that because it's going to be something like that would trigger a move up and out of here. So let's look at the technicals here, and so you can get a really clean look of exactly what's going on. I think beans are in a really important spot. We've broken the Chiku spot here where we're below where we were 26 weeks ago. We did not want to see that happen, but we've held up and inside the cloud. So I think this is a bullish bias here, but I would call it a weaker bullish bias than we probably have had in the past, just because we're now below where we were 26 weeks ago. We are oversold on the RSI. We're oversold on some other indicators. But then as we work towards the shorter side of, or the shorter time frames, and I'm in March beans here, okay? So this is a little bit more holistic view. This is your daily chart, this is a 4-hour chart, and this is a 1-hour chart. What we're starting to see is some major bottoming signs right through here, okay? We've got a big issue working right here, which if we can push up and take out this high right here, you will have a sequence of a higher high, a higher low, followed by a higher high. And that would be the first time that sequence has happened since right here, where you had a rally, a pullback, and a rally that broke the top of it. That would be the first time since June that beans were able to do that and hold it if we find some strength today. Now, on the flip side, if we take this low out right here, which is yesterday's low, then I don't think we're done yet. So I think beans are at a really critical short-term spot right here, and you can see that on the shorter-term clouds. We're right into the congestion zone. We're inside both the 4-hour and the 1-hour clouds. Beans are at a really important spot. And I think part of the bearishness here is, or the risk is the fact that the November contract goes into delivery, I think tomorrow. I think tomorrow's first notice day. Or maybe it's Friday. And so we're rolling everything to March. So if you're short beans, you're going to roll probably to January. You might move out to July or out to March if you want to. So there's some issues here, but with the reality of what's happening in China and the reality of that pent up demand moving forward, I think beans are going to stay well supported, and I don't want to get short them here at all, even though short term it could be a little bit painful. All right, now let's switch to corn. Let's go to December corn, and we'll kind of run through the corn contracts. Okay, here's the same situation on corn. Here's your daily. Daily, we're up and inside the cloud, and a push up above here and a close would signal a return to an uptrend. And on the weekly chart, it looks really good as well. I'll get to that in just a second. Your short term and both your 4-hour and your 1-hour charts look really pretty good in corn. And fundamentally, what do we have happening, right? We have the cost of production increasing like crazy. We have a massive crop, but yet we have strengthening basis, and we have narrowing spreads coming right into the dead center and to the latter part of harvest. So I don't think that's bearish corn at all. I think that the momentum seems to be building to the upside, and I would look for this to work on up higher. Ethanol margins are extremely profitable. They're as strong as they have ever been, and I don't think that that's going to go away because of this, because of the reasons that we just talked about, right? And you also have to put the feed context into corn too. We're not going to be feeding wheat anytime soon. We're now going to be feeding corn. So the feed ration is up, the ethanol grind is up, and exports will come because China has to have so much of it. They can't ignore us forever, but they continue to slow play it, hoping that ocean freight will decline. All right, so let's look at March corn. We're going to be rolling out of that here in the next out of Dees here in the next couple of weeks. March corn looks exactly the same. Looks to us like we're getting ready to come challenge the $6 mark. I don't know what the catalyst will be that will get it there, and that is going to hold true all the way down to 535 March on a move back down outside of this cloud. And honestly, anything above 520, anything above these swing lows right here, I'm just not bearish corn at all. If we do break down into here again, then I would expect that to give way to lower prices, but I don't know what that would. I don't know what'll get us there with that pent up demand. All right, Dees 22. Let's talk about it. We're sitting at contract highs. And we're starting to break up. Look at the upward tilt here, right? We have each subsequent low just seems to be continuously higher, which means it just continuously is getting bought. Why is it doing that? Well, because I just showed you that some smart people are talking about losing 3 million acres of corn, and I don't think we can sustain it. So we've got wheat shortages, we've got shortages in all the minor crops, we've got nitrogen and other issues that are pulling that are making the economics not great for corn. So if corn's going to hold acres, it can't break too far. So not bearish December corn at all. So if we're short corn at all, it's in the December timeframe. I think December, January, February, March, corn's going to be extremely well supported, especially if there's any type of weather issue at all. So I think that the single most important fact in corn is the fact that we're harvesting the second largest crop in history, and we're holding 540 a bushel. I don't think you need to make too many more statements to support the bullish case there. All right, now let's look at wheat. Where is my wheat? Here is December wheat, out to new highs yesterday. We had a really wild day in wheat yesterday where we started off lower, we rallied really quick, and we came all the way back down. The overnight session was pretty tame compared to what yesterday was. I don't see wheat getting into a huge downtrend here. I just think that the fundamentals are too bullish. But given yesterday's action, a move below yesterday's low would also be a move back inside these highs. If we break it and close back down into this range, then we may look at putting some hedges on there. But I want to see what the price action does, and I want to see how forceful of a move it is. If it's a stop running move and is followed with light volume and not a lot of pressure, then I'm not too concerned about it. If we had closed at the bottom end of our range yesterday, I'd be more worried. But given the long shadow, this just tells us that wheat needed to come test, right? It's real natural to break a big resistance zone like this and come back down and test it. That's as natural as it can get for a market to do, and I wouldn't expect wheat to do anything less. Okay, that's kind of a lot with wheat. There's a lot going on there. It's a hard market to trade because it pushes around so far and so fast, but you just got to keep really wide stops and give it a lot of room, because otherwise it'll trick you into a position and take yourself out. So if you have to pick a point, probably down here at this 742 level, and next year's wheat looks the same. I don't think it's quite time to hedge it yet. I've said that for 3 weeks now. I think we got a little bit more upside to go, and I think we're going to put pressure on $8 a bushel just because the fundamentals are that bullish. Okay, that is what I have for y'all today. I hope that was helpful. We got a lot of work to do and a lot of volatility coming over the next 6 months. So remember, there is risk in trading futures and options, and you should do so in light of your own financial condition, and it is certainly not suitable for everybody. I hope you all have a great week, and we will talk to you next Wednesday.